Perhaps no state has been more affected by the foreclosure crisis than the state of Nevada. And in the wake of the foreclosure crisis, what we're seeing is that law enforcement has really ramped up investigation as to what the root causes or what they feel the root causes of the mortgage crisis are. So right now in the state of Nevada, we're seeing a lot of prosecutions where allegations of mortgage fraud come into play. And mortgage fraud encompasses a wide range of scenarios involving deceptive mortgage practices. It can involve false information provided to a lender. It can involve artificially high appraisals that help to entice the bank to lend a large amount of money for the purchase of a home. It can involve straw buyers, all of which are prosecuted in Nevada under the title of mortgage fraud.
Here in Nevada, one common example of mortgage fraud is what is known as a false loan modification scheme. This often involves someone trying to prey on a distressed homeowner by perhaps offering to reduce principal, avoid foreclosure, and allow someone to stay in their home. Oftentimes, that person will take money up front, but then not do anything for that distressed homeowner, and they often go into foreclosure anyway.
Another common example of mortgage fraud here in Nevada is using false information on loan applications. Now, today, lending standards have become much more strict, and lenders will want to verify your income and your assets and your debts and your taxes before authorizing a loan. But back in the day, but before the market crashed, there were lots of mortgages that were issued based on what was called stated income. And these sort of gained a term in the industry, liar loans. Liar loans because people would lie. They would lie about their income. They would lie about the assets that they had for collateral. They would lie about their debts and liabilities. And none of this was really verified. And what I think a lot of people didn't realize or didn't sort of pay attention to at the time is that they were signing under penalty of perjury that all of this information was true and correct. And today what we're seeing is state and federal authorities going back and prosecuting many of these people for mortgage fraud, for perjury, based on this misinformation that they put in their applications. And the reality of the situation is that a lot of these listing agents and escrow officers and lenders had an incentive to push these deals through. They wanted their commissions. And so they would really coach the loan applicants in what they needed to say to meet the lending standards, to get the loan, even if that meant providing misinformation. And the culture in the industry sort of became that this was just how things were done. These were how deals were made. This is how people got their homes. This is how people made their investments. Everybody was doing it. It wasn't seen as something that was unethical or illegal. And people who did provide misinformation and perjure themselves never imagined that they would someday face the consequences of being prosecuted for a felony and going to prison for what they did.
Straw buying usually involves a situation where someone wants to buy a home, but they lack good credit. So usually that person will recruit someone else, often known as the straw buyer, with good credit to stand in for them in order to obtain a loan from a bank. That person can find themselves facing bank fraud because they deceived the bank into providing them a loan for someone who actually did have bad credit.
It's not uncommon to see a straw buyer scheme where the straw buyer is really more of an unwitting victim to the sophisticated scheme of other players. So a straw buyer may be offered several $1,000s to sign documents for the purchase of a property, where there were third parties like the buyer or the mortgage lender or the realtor that had a lot more to gain than the straw buyer. And the straw buyer is the one that's being prosecuted and made the scapegoat for the entire transaction. The main statute here in Nevada with regard to mortgage fraud is
NRS 205.372, which makes it a felony to be involved in a deceptive mortgage fraud transaction. If you're convicted under this statute, the penalty is what we call a Category C felony here in Nevada, which is 1 to 10 years in state prison. However, if the court finds that there's been a pattern of mortgage fraud activity, then it becomes what we call a Category B felony, and the penalty is 3 to 20 years in Nevada state prison. You could also be prosecuted separately for perjury, which carries 1 to 4 years in state prison. And also you could be prosecuted by the federal authorities and be sent to federal prison. So the stakes and the consequences of being convicted for one of these mortgage fraud crimes are draconian. And if you find yourself charged with one of these mortgage fraud schemes, you want to do everything possible to fight the case and avoid being convicted.
Ultimately, here in the state of Nevada, what we've seen is that law enforcement is casting a very wide net over the whole state of Nevada, and consequently, a lot of innocent people, particularly here in Clark County, Las Vegas, Nevada, have been reeled in and are being prosecuted for mortgage fraud related crimes. Here at the Las Vegas Defense Group, we are determined to make sure that our clients are not wrongfully drawn in by this widely cast net. And we intend to defend each and every one of our clients based on the specific roles that they play to ensure that an innocent, small, or no role player does not get sent to prison as a scapegoat for the actions of more sophisticated parties.
The most common defense in a mortgage fraud case is that the individual did not have the intent to defraud. In Nevada, mortgage fraud is a specific intent crime. One cannot be convicted of mortgage fraud unless the state is able to prove beyond a reasonable doubt that the individual had the specific intent to defraud someone else. Therefore, if someone's acting in good faith and did not have the intent to deceive someone else, then the person is not liable for a crime.
Another common defense to mortgage fraud here in Nevada is that the person was acting under the instructions or information provided by others. So, for example, you may have been an escrow officer who was simply acting under the directive of your employer. Or you may have been a loan officer who was just acting on information that was provided to you by appraisers and applicants. If you were acting in good faith, just on information and instructions given to you by third parties, then again, you should not be held liable for mortgage fraud.
During the time when the seeds of this crisis were planted, it was very easy to get a loan. And there was a lot of pressure on mortgage lenders and appraisers. The higher the appraisal value, the more the bank would lend. Sometimes people could get money out on the front end to furnish the home or to pay off debts in the process, so it became a magical elixir. And so we saw a lot of scenarios where people bit off more than they could chew. They bought a house that wasn't really worth what they thought it was, found themselves in debt, ultimately lost the home, and may now be facing prosecution in the wake of everything that they've already lost. Ultimately, we have to ask ourselves as a community, who do we blame for the events that unfolded and the harm that was caused? Do we scapegoat and blame the appraisers, the mortgage lenders, the realtors, or do we ultimately have to just accept some shared responsibility and try to move forward in a positive direction?